Impact Report, anticipated 30% shift in investment strategies across finance, defense, and healthcare sectors by Q1 2025. Date, January 30, 2025. Overview. This report analyzes the expected 30% shift in investment strategies across key sectors, finance, defense, and healthcare, by the first quarter of 2025. The forecasted changes are driven by a confluence of factors including evolving market dynamics, technological advancements, and regulatory pressures. As firms adapt to these changes, the implications for international competitive dynamics and policy outcomes are significant. Key drivers of change. 1. Market dynamics. The ongoing volatility in the investment landscape is attributed to rising interest rates and geopolitical tensions. These conditions compel firms to rethink traditional investment strategies, leaning towards alternative investments such as private credit and exchange-traded funds (ETFs). The growing investor appetite for low-cost, transparent investment vehicles is reshaping the landscape. 2. Technological advancement. Artificial intelligence (AI) is emerging as a transformative force across sectors. Firms that effectively leverage AI technologies are expected to gain a competitive edge in investment management, operational efficiency, and risk management. The integration of data analytics into investment strategies is becoming crucial for firms aiming to enhance decision-making processes. 3. Regulatory changes. Regulatory pressures are prompting firms to diversify their product offerings and to comply with enhanced standards in risk management and transparency. Increased merger and acquisition (M&A) activity is also seen as firms seek to bolster capabilities and adapt to evolving regulations. Sector-specific insights. Finance sector. A shift towards low-cost ETFs and alternative investments is anticipated, driven by a sustained preference for low expense ratios. Traditional mutual funds are experiencing outflows, while ETFs and index funds are gaining traction. AI is expected to play a pivotal role in enhancing operational efficiencies and risk assessments. Investment firms are increasingly using AI to analyze market data and investor behaviors, leading to more informed decisions. Defense sector. Investment is projected to concentrate on innovative technologies, particularly those enhancing national security and defense capabilities. The increasing geopolitical tensions necessitate a strategic pivot towards defense technologies. The defense sector is likely to witness a significant increase in funding aimed at R&D for advanced military technologies, including cybersecurity and unmanned systems. Healthcare sector. The aging population and rising healthcare demands are driving investments in biotechnology and health technology solutions. The focus on innovative treatments and telemedicine is expected to accelerate growth in this sector. Regulatory scrutiny regarding healthcare costs and quality is leading firms to adopt more sustainable practices and to innovate in care delivery methods. Complete timeline of events. 2023, signs of volatility emerged due to rising interest rates and geopolitical instability, prompting firms to reconsider traditional investment strategies. Late 2023, investment flows into alternative assets begin to slow, with firms exploring AI technologies for operational enhancements. 2024, a marked shift toward low-cost ETFs and alternative investments occurs as regulatory pressures mount. Increased M&A activity is observed as firms seek to enhance capabilities. Q1 2025, a projected 30% shift in investment strategies is expected as firms integrate AI, diversify into alternative assets, and navigate evolving regulatory landscapes. Conclusion. The anticipated shift in investment strategies by Q1 2025 reflects a complex interplay of technological advancements, regulatory pressures, and changing market dynamics across the finance, defense, and healthcare sectors. Firms that proactively adapt to these changes are likely to position themselves advantageously in an increasingly competitive global landscape. As investment strategies evolve, the implications for international competitive dynamics and policy outcomes will be profound, necessitating ongoing analysis and strategic foresight. This report synthesizes insights from multiple sources including Deloitte, AIM, Max Media and Amwins, highlighting the critical trends and shifts expected in the investment landscape by early 2025. It aims to inform stakeholders about the anticipated changes and their potential impact on strategic decision-making across sectors. The anticipated 30% shift in investment strategies across the finance, defense, and healthcare sectors by Q1 2025 reflects several counterintuitive insights from the underlying analyses and predictions. 1. Technology adoption versus market volatility. While traditional wisdom suggests that market volatility leads to conservative investment strategies, the opposite is expected. Firms are likely to double down on technology adoption such as AI to navigate volatility, viewing it as an opportunity to innovate rather than retreat. This indicates a fundamental shift in how firms perceive risk. They are increasingly seeing technology as a buffer against market fluctuations. 2. Shift towards low-cost products. The prevailing trend is a movement towards low-cost investment vehicles like ETFs, which contrasts with the historical preference for actively managed funds. This suggests that investor priorities are shifting towards transparency and cost efficiency, even in uncertain markets. The expectation that low expense ratios will dominate the landscape challenges the long-standing notion that higher fees are associated with better performance. 3. Emerging market demand in crisis. In sectors like insurance, an increase in complex risks, e.g., those derived from climate change, is expected to drive demand for specialized coverage, contradicting the typical assumption that crises lead to reduced investment in risk management. Instead, firms are expected to capitalize on these emerging risks as new opportunities for growth. 4. Private capital resilience. Although private capital faced headwinds in 2023, the anticipation of a resurgence in investment activity contradicts the assumption that poor performance leads to long-term declines. Instead, firms are positioned to leverage dry powder, uninvested capital, to seize new opportunities, suggesting a resilience in the private capital market that may not align with immediate past performance. 5. Regulatory changes as catalysts. Regulatory pressures are often viewed as burdensome, yet the analyses indicate that these pressures could catalyze shifts in investment strategies, particularly in the healthcare sector. Firms may use regulatory changes to innovate product offerings, thus contradicting the typical narrative that regulations stifle growth. 6. AI as a double-edged sword. While AI is heralded as a transformative force, the predictions highlight a counterintuitive risk. Firms lagging in AI adoption may face existential threats. This reflects a nuanced understanding of technology's dual role as both a competitive edge and a potential pitfall where failure to innovate could lead to severe competitive disadvantages. 7. Geopolitical tensions driving investment, rather than leading to a withdrawal from international markets. Geopolitical tensions are expected to drive firms to seek new opportunities in less stable regions. This counters the traditional view that uncertainty typically leads investors to safer, more stable markets. 8. Healthcare sector dynamics. Despite the healthcare sector's financial challenges, the prediction that it will attract substantial investment underscores a counterintuitive belief that growth can arise from distress. The anticipated increase in private equity involvement indicates a strategy of capitalizing on operational inefficiencies rather than avoiding them. 9. Insurance market evolution. The insurance market's adaptation to complex risks and the emergence of new products like parametric insurance defy the notion that traditional models will prevail in challenging times. The shift towards innovative coverage solutions indicates a recognition that evolving risks require equally adaptive strategies. 10. Behavioral finance and investment decisions. The emphasis on understanding investor psychology highlights a counterintuitive aspect of investment strategies. Firms are increasingly recognizing that emotional responses can drive market movements, suggesting that successful investment strategies must integrate behavioral insights rather than rely solely on quantitative analyses. These insights reveal a complex landscape where traditional assumptions about risk investment behavior and market dynamics are being challenged by emerging trends and technological advancements. Here are some important insights from the report on the anticipated 30% shift in investment strategies across finance, defense, and healthcare sectors by Q1 2025, with a focus on content that may be overlooked and its significance. 1. Technological integration and AI adoption. While the report mentions the integration of AI and machine learning, many readers may underestimate the profound implications of this technological shift. AI's role in investment management is not merely about efficiency, it fundamentally alters decision-making processes. Firms that successfully implement AI technologies can significantly enhance their competitive edge by making data-driven decisions faster and more accurately than their competitors. Significance: the competitive landscape is set to be defined not just by who has the most capital but by who can leverage technology most effectively. This could lead to a new class of market leaders, as firms that lag in adopting AI might struggle to keep pace in a rapidly evolving environment. Investors should scrutinize firms' technological capabilities as a crucial part of their investment thesis. 2. Shift towards alternative investments. The trend toward alternative investments is significant yet often overlooked. The report notes that the shift to low-cost ETFs and alternative assets like private credit is expected to reshape portfolios across sectors. This move signifies a broader acceptance of investment vehicles that were traditionally considered niche. Significance: this shift could democratize access to alternative investments, allowing smaller investors to participate in asset classes that typically require higher minimums and more complex structures. It may also indicate a change in risk appetite among investors, moving away from purely traditional assets in search of higher returns, especially in a low-interest rate environment. This could lead to an influx of capital into private equity, venture capital, and other previously less accessible sectors, changing the dynamics of investment flows. 3. Regulatory changes and their impacts. The report touches on evolving regulatory landscapes, particularly how firms are adapting to compliance requirements. However, the intricate relationship between regulatory changes and market behavior is often underestimated. Significance: regulatory changes can create both risks and opportunities. For instance, firms that can swiftly adapt to new regulations can gain market share and enhance their reputational strength, while those slow to comply may face penalties or reputational damage. Furthermore, regulatory developments can lead to new investment products designed to meet compliance needs, creating opportunities for innovation in financial products. 4. Consumer behavior changes. The report suggests that shifting demographics and investor preferences are influencing market trends, particularly in the healthcare and technology sectors. It highlights a growing demand for sustainable and socially responsible investment options, especially among younger investors. Significance: this change in consumer behavior is not just a passing trend, it reflects a fundamental shift in values. As younger generations take on more economic power, their preferences will dictate market dynamics. Companies that fail to recognize and adapt to this shift risk alienating a significant portion of their potential investor base. This can lead to long-term viability issues for firms that do not align their strategies with these evolving consumer values. 5. Geopolitical tensions as investment catalysts. The report mentions geopolitical tensions as a factor driving shifts in investment strategy, particularly in the defense sector. While many might view these tensions as mere background noise, they are critical influencers of market behavior. Significance: geopolitical instability can lead to sudden market shifts, as seen in defense stocks during crises. Investors need to remain vigilant and adaptive, as these tensions can create both risks and opportunities. A proactive approach to geopolitical analysis will be essential for investors looking to capitalize on emerging trends or protect their portfolios from unforeseen disruptions. 6. Impact of inflation and economic indicators. The link between inflation, interest rates, and investment strategies is a key theme in the report. However, the nuanced implications of these economic indicators on specific sectors may not receive adequate attention. Significance: inflation can erode purchasing power and impact consumer behavior, affecting sectors differently. For instance, healthcare may become a more attractive investment as consumers prioritize essential services amid rising living costs. Understanding how different sectors respond to inflationary pressures can provide investors with a strategic advantage in asset allocation. 7. Mergers and acquisitions (M&A) trends. The report highlights increased M&A activity as firms seek to bolster capabilities amid competitive pressures. However, the strategic rationale behind these mergers is often oversimplified. Significance: M&A can be a double-edged sword. While they can enhance market positioning and operational efficiencies, they can also introduce integration risks and cultural clashes. Investors should evaluate the strategic fit and potential synergies of merger targets carefully, as poorly executed integrations can undermine value creation. 8. Emerging market opportunities. Emerging markets are mentioned as areas of growth, but the specific dynamics driving this growth might not be fully appreciated. The rise of the middle class in developing countries and their increasing consumption patterns can significantly influence investment strategies. Significance: as emerging markets grow, they present new avenues for investment, particularly in consumer goods, technology, and infrastructure. Firms that strategically position themselves to capitalize on this growth can gain substantial market advantages. Investors should consider geographic diversification in their portfolios to tap into these expanding markets. Conclusion: the anticipated 30% shift in investment strategies across key sectors by Q1 2025 is influenced by a complex interplay of technology, regulatory changes, demographic shifts, and geopolitical dynamics. Each of these factors carries significant implications that extend beyond surface-level observations. Investors and firms that recognize and adapt to these nuanced shifts stand to gain a competitive edge in an evolving marketplace. The insights drawn from the report should encourage a deeper analysis of market trends and a proactive approach to investment strategy formulation. 1. Technological integration and AI adoption. The anticipated shift in investment strategies emphasizes the critical role of advanced technologies, particularly artificial intelligence (AI) and data analytics. Firms that successfully integrate AI into their operations can enhance efficiency, improve risk management, and gain a competitive edge. AI's potential to revolutionize investment management is underscored by its application in areas such as portfolio management, customer interaction, and operational processes. This technological transformation is not just about adopting new tools but also about reshaping business models to leverage data-driven insights for better decision-making. 2. Market dynamics and economic indicators. The investment landscape is being shaped by various economic factors, including interest rates, inflation, and geopolitical tensions. These indicators influence investor sentiment and dictate shifts toward low-cost investment vehicles like ETFs. The transition from traditional mutual funds to alternative assets highlights a broader trend of diversification in investment strategies. Understanding these market dynamics is crucial for firms looking to adapt their portfolios to meet evolving investor preferences and capitalize on emerging opportunities. 3. Regulatory changes and strategic adaptation. Regulatory pressures are prompting firms to rethink their investment strategies and operational frameworks. The need for compliance with evolving regulations and the integration of sustainability considerations into investment decisions are becoming increasingly important. Firms that proactively address these regulatory challenges and align their strategies with compliance requirements stand to benefit in terms of risk management and market positioning. This highlights the imperative for organizations to stay adaptable and responsive to the regulatory landscape while pursuing innovative investment opportunities. 4. Sector-specific trends and investment opportunities. The anticipated 30% shift in investment strategies will vary across sectors, with finance, defense, and healthcare presenting unique challenges and opportunities. For instance, the healthcare sector is poised for growth driven by an aging population and technological advancements in health tech and telemedicine. Similarly, the defense sector is likely to see increased investment due to geopolitical tensions necessitating a focus on innovation and modernization. Understanding these sector-specific trends will enable firms to tailor their investment strategies to align with evolving market demands, ultimately leading to enhanced portfolio performance and competitive advantage. These 4 points encapsulate the multifaceted nature of the anticipated shift in investment strategies, highlighting the interplay between technology, economic indicators, regulatory frameworks, and sector-specific dynamics. Each of these elements will require in-depth analysis and discussion to navigate the complexities of the evolving investment landscape effectively. 1. The Great Depression 1929 to 1939. The Great Depression was one of the most significant economic downturns in history, leading to a massive shift in investment strategies. The stock market crash of 1929 prompted widespread financial panic and resulted in a re-evaluation of investment approaches, with many investors moving away from speculative investments in stocks to more stable assets such as government bonds and gold. This shift was also influenced by the regulatory changes enacted in response to the crisis, including the establishment of the Securities and Exchange Commission (SEC) in 1934, which aimed to restore investor confidence and regulate the securities industry. 2. Post-World War II economic boom 1945-1960s. After World War II, many countries, especially the United States, experienced a significant economic transformation. The wartime economy transitioned into a peacetime economy, leading to increased consumer spending, a booming housing market, and the rise of technological innovations. This era saw a shift in investment strategies as individuals and institutions began to invest heavily in consumer goods, real estate, and stocks, driven by the overall optimism surrounding economic growth and expansion. The introduction of pension funds and mutual funds also transformed the investment landscape, allowing more people to invest in the stock market. 3. The dot-com bubble late 1990s, early 2000s. The late 1990s saw a dramatic surge in technology investments, particularly in internet-based companies, leading to the dot-com bubble. Investors rapidly shifted their strategies towards technology stocks, with many believing that the internet would revolutionize business. This speculative investment behavior was fueled by the rise of venture capital and the ease of access to stock markets through new online trading platforms. However, the bubble burst in 2000, resulting in significant losses and a re-evaluation of risk and investment strategies, leading to more cautious and diversified approaches in the years that followed. This period highlighted the importance of thorough research and due diligence in investment decisions. Future outlook: anticipated shift in investment strategies across finance, defense, and healthcare sectors by Q1 2025. As we approach Q1 2025, a projected 30% shift in investment strategies is anticipated across the finance, defense, and healthcare sectors. This shift is primarily driven by evolving market dynamics, technological advancements, and regulatory changes. Below is an analysis of the expected trends and their implications for international competitive dynamics and policy outcomes. 1. Technological integration and investment management. The integration of artificial intelligence (AI) and machine learning into investment strategies is set to become a defining characteristic of the financial landscape. Investment management firms that effectively harness these technologies are likely to gain a competitive edge. According to Deloitte's 2025 Investment Management Outlook, firms that adopt AI for operational efficiency and risk management will be better positioned to navigate the complexities of a changing market environment. Key predictions: increased use of AI. Firms will increasingly leverage AI for customer insights, portfolio management, and risk assessment, enhancing decision-making processes. Diverse product offerings. there will be a notable shift towards low-cost exchange-traded funds ETFs and alternative investment vehicles, as investor demand for transparency and lower fees grows. 2. Healthcare sector dynamics. The healthcare sector is expected to be shaped by demographic shifts and technological advancements. The aging population will drive demand for healthcare services, while innovations in telemedicine and biotechnology will create new investment opportunities. Key predictions: growth in telemedicine. Investment in telemedicine and healthcare technology will continue to expand, reflecting changing consumer behaviors and the need for efficient healthcare delivery. Focus on biotech and pharmaceuticals. Investors will increasingly target biotech firms and pharmaceutical companies that demonstrate potential for innovative treatments and solutions. 3. Geopolitical and economic influences on defense investments. Geopolitical tensions will continue to influence defense spending and investment strategies, as nations prioritize national security and technological advancements in defense systems. Investment in defense technologies will rise. Key predictions: increased defense budgets. Governments are expected to allocate higher budgets towards advanced military technologies, including cybersecurity, drones, and AI-driven defense systems. Public-private partnerships. Collaboration between governments and private firms will become more prevalent, enhancing innovation and efficiency in defense-related investments. 4. Economic indicators and market performance. Economic conditions, including interest rates and inflation, will play a crucial role in shaping investment strategies. Analysts predict that moderate GDP growth and manageable inflation rates will characterize the economic landscape through 2025. Key predictions: interest rate adjustments. Central banks may adjust interest rates to stimulate economic growth, impacting borrowing costs and investment behaviors. Sector-specific performance variations. While technology and healthcare sectors are likely to thrive, traditional sectors may face challenges due to changing consumer preferences and regulatory pressures. 5. Emerging investment vehicles and market accessibility. The rise of innovative investment platforms and vehicles will enhance market accessibility for retail investors. Fintech solutions will democratize investment opportunities, enabling a broader range of investors to participate in various asset classes. Key predictions: increased retail participation. The accessibility of investment platforms and the popularity of ETFs will attract more retail investors, reshaping the investment landscape. Growth in sustainable investing. There will be a surge in demand for responsible and sustainable investment products, reflecting shifting investor preferences towards environmental, social, and governance (ESG) criteria. 6. Policy outcomes and regulatory changes. Anticipated regulatory changes will significantly impact investment strategies across sectors. Increased scrutiny on investment products, particularly in the financial and healthcare sectors, will prompt firms to adapt their approaches. Key predictions: stricter regulatory frameworks. Regulatory bodies are likely to implement stricter guidelines governing investment products, particularly those focused on technology and healthcare innovations. Focus on transparency and accountability. Firms will need to enhance transparency and accountability in their operations to meet evolving regulatory demands and investor expectations. Conclusion: the anticipated 30% shift in investment strategies across the finance, defense, and healthcare sectors by Q1 2025 reflects a multifaceted transformation driven by technological advancements, economic conditions, and regulatory changes. Firms that proactively adapt to these changes and leverage emerging technologies will differentiate themselves in an increasingly competitive landscape. As we move towards 2025, the integration of AI, the growth of sustainable investment solutions, and the focus on healthcare innovation will be pivotal in shaping investment strategies and policy outcomes.